Right. Good day and welcome to JDX Academy tutorial. All right, in this tutorial, we're going to be talking about market structure. Okay, but before we dive in, if you know you're not subscribed to this channel, please do well to hit the subscribe button and, of course, turn on notification bell so that subsequent videos would come to your device. All right, just as you said, we're going to be talking about the structural market structure. I know I've made a previous video that gives an overview of what structure is all about, but this is going to be detailed and more emphatical on issues or details that everyone trader needs to know. Okay, in our previous video, we said that when you see um, the chart moving in this way, of course, it shows that the market is bullish, and on the other hand, when the market is moving in this way is a sign that the structure is bearish. Okay, yeah, this happens, but then that is not all that we need to know about market structure. For every market movement that happens, there are key things that every one trader would need to point out, and one of those things is what we call break of market structure. Sorry, one of those things is what we call break of market structure. What is this? Uh, sorry about that. All right, I do not know why my test tool here is misbehaving, but then I think we can still go on without that. So what we say when we look at market structure, we look at terminologies like break of market structure. We look at terminologies like structural levels. All right, these key things are very, very important, right? And why are they important? It helps to give you information on what the trend is doing or what the market is doing and how what would really invalidate a particular structure, right? Of course, let's get to dive in. So when we move on with the chart, let's say on a bullish structure, we have something like this where we are having higher highs and higher lows. Now, for every time we have something like this, for every time we have a new high, we have a structural level, and then this is structural level for this. This is structural level for this high, and then this also, sorry, and then this also is the current structural level for this high. Why do we call it structural level? This is because if for any reason the market comes down to this point and breaks down it, so one could possibly say there is a break of structure. All right. This break of structure for this very case is positioned such that there could be a shift in the market structure or what other persons may call change in market, a change of character, right? Change of character. So what that means is that these highs may not continue going high. So we may get something like this, and then the market will now move downward. So you could see that there is a switch from bullish structure towards to bearish structure. Okay, so as much as that happens, the level that helps us to check that for a bullish structure is the last low that was created before that structural level before that structure was changed. What are we trying to say? So let's get to illustrate this over again. Now, what that means is that for every structure that is being printed, all right, we have a low, we have a high, we have a higher low. As much as this higher low is here, this structure is valid as much as it has not gone below this low. So if the market is able to produce a new high, it means this structure, the level for this structure to be bullish has moved from this initial point to this new high, sorry, for this new low that was able to push up for a new high, right? That means the structural level lies somewhere around this region. Okay, now the market can actually do whatever it wants. The market can go on this way, do anything that it wants to do. As much as it has not closed or broken below this low, we are still what? Bullish, right? So the market can come to the line and test it and go way up, right? So I want you to take note of this. Now, once sometimes when people see stuffs like this, they'll be like, "Oh, but we are having lower lows on this very case." I think that takes us to what we call um types of structure, where we have the external structure, which is the main structure, and then the internal structure. And this scenario explains it all. Now, there could be situations where the overall trend is saying we are bullish, all right? But just somehow you are seeing some sort of lower lows and then higher lows, or sorry, or lower highs within a particular structure. Don't forget, I'll say again, the 1 hour, the 4 hours, the the 1 day is showing that the structure is bullish. But when you come down to 5 minutes, you are seeing that from what we have said about structures, we are actually seeing lower lows. We are seeing lower highs, meaning that this 5 minute structure is rather bearish. You don't need to confuse yourself. Yes, that is how the market works. So, what you are seeing in such a scenario is what we call internal word structure. The internal structure is just more of a retracement. All right. It doesn't mean that because 5 minutes is doing that, it means that the overall structure has been invalidated. So, how do you get to know when the structure is invalidated or not? That is when this idea of structural level comes in. Okay, so I would put it this way: a structural level is the last high, or sorry, for a bullish trend, a structural level for a bullish or yeah, for a bullish or an uptrend is the last high, or sorry, the last low that produced the latest high. The last low that produced the latest high. Oh, so what is the last low? This is the last low and this is the latest high. So, or the recent high, anyhow you put it. So, this low becomes what? The structural level for this market to continue. So, what that means is chances are if this spikes below this, the structure may be invalidated. All right. I'm saying may be invalidated because this is not entirely true. I just want you to understand the concept. It is not entirely true because most of the time, what really happens here is 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 liquidity grab. All right, but then for liquidity grab, you need to have a robust understanding of these things before you understand it better. But let's, because of the sake of this video, I said it's going to be detailed. I'm going to break this down. For me, over the years of study on the chart, I consider structural level to not be the last low that produced the recent high, which is this very low. I consider it to be the last two lows. Yes, I consider it to be the last two lows. Why is it so? Because there would come a time where you will see that, oh, when you go with what we said earlier, you see the market doing this. but then it will still continue higher. One would wonder, I thought the structural level has been broken. I needed to see maybe a retracement around this region, and then I'll enter the trade for a sell, and before you know it, your trade is failing. Right? So, yes, there are so many cases where you see the market just moving in this way. Yeah, people try to look down on these things that this stuff doesn't work well. One of the things I always tell people is this: whatsoever you see anybody teaching in the market, at some point it worked, even if it is not so often. But the truth is, it worked in on the chart, right? Yeah. So yeah, it may not be a good pattern or a good system, but even if it is one time, you have seen it work. So yes, it worked on the market, right? But then this may be just this last chart, may be how some of the pairs behave on an uptrend. All right. Yes, we see that working, and people who trade it, they are cool with it. And yet, on some other hand, we see the market working this way. It produces a low, it produces a new high, and comes back to take out the new low. Sorry, the recent low. Yes, take out the recent low and still continues. This is one of the things I struggled with while I was yet starting, because whenever I see something like this, because of the orientation I once had or I was once given by my tutor, I believe that, oh, the structural level has been broken. I should expect the retracement anywhere within this region and then jump onto the trade for a sale. But you see that your trade would fail. So upon study of the chart, I came to adopt a system that do not consider this guy as a structural level. Rather, it considers the last two lows as the structural level, which is this very low. So for me, this low becomes my structural level. And why is it so? Because I, of course, would the market would most times do this, take out this guy for liquidity grab, so that the market will continue. And we call that internal liquidity. Why is it so? The market would always need fuel to continue going higher. So that fuel would only need to be where the stop losses of traders are resident, right? And of course, for this very move from here to this point, the ideal level where anybody who took this trade could likely have their stop loss is just below this low. All right, so the market doesn't want them to be on the trade, so the market would have to come back to stop them out before it continues. I don't know if you're getting what we're saying here. So, yes, structural level, if you want to get it right, it becomes the last two lows. The last two lows. So we have something like this. Now, instead of considering this point as your structural level, you rather consider this point as your structural level, bearing in mind that the market could want to grab liquidity at this point and then still continue. Oh, yes, take this critically, especially for major pairs. This is how the market works. All right, but for the non-major pairs, other currency pairs, that is the minor pairs, you most likely would have just this way, such that you may consider your structural level this way. Okay, but for me, what I advise strongly for every one trader, for every one student, is don't just rush out there to trade any particular pair because you have a good concept about the forex market. Truth is that the movement of currency pairs in the market, be it crypto, the movement of synthetics, the movement of futures, commodities, and all of that, they differ, right? They differ. So you need to study the chart well, back test well, see what is working and see what is not working. By this, you would be able to know what exactly you need to do and then how you would have to be on a safer side while trading the market. All right. So yes, these are the two ways for which one would know what structural level is all about. One of it is that structural level for a bullish structure considers the last two lows as its a structural level, such that once that level is spiked below, the market is likely to take a shift. There should be change of character. And for a downtrend, let me illustrate that simply. We have that the market is doing this. Now, if we're considering what we're saying for the last two lows, this is going to be our structural level. While if we are considering what we are saying for a recent high, in this case, sorry, this is for bearish. So we talk about recent high that produced the recent low. Okay, so we're talking about the recent high that produced the recent low for a downtrend. This could be it. All right. These are two occasions where one could say, oh, when once the market spikes above this, there's chances as there is a change of what of character, all right, to the upside, character to the upside. All right. In likewise in this other case, when the market does this, chances are the market would want to change to a bullish structure. So this is the way the market works, and this is how change of character works. Okay. Now, when does break of structure or when does change of character comes in? I'll say it again. Change of character comes in when the price of the market, or when the price, of course, of the market invalidates your structural levels. All right. And I've made it clear that structural levels are determined from either the last low that produced the recent high, that is for a bullish structure, or the last two lows that produced the recent high. Okay. Now, let me give you a final scenario before perhaps I would end this video. Right. In some cases where you have this, the market is going up, okay, and then you have a sweep of liquidity. The market comes here. Don't forget, for this case, I consider this second low to be my structural level. So the market comes here and switch this sweep liquidity here and goes on higher, right? Fine. Now, for every time there is a sweep of liquidity, at this point, it means that this structural level is no more here. It has changed from here to here. Because why? Liquidity here that was the basis for which we are considering this other guy to be our structural level has been swept. Thus, as much as this move has produced a new high, this level has changed from here to this point. So if at all we want to see the market doing anything, it should just come around this region and go on higher. All right? Yes. And of course, this thing remains valid. Yes. Let me delete this just so you have space for this understanding. Please, whatsoever we're saying here, you can always invert it to get what it would be on the other side. So once this liquidity was swept here, the structural level initially here has moved to the low after liquidity sweep that produced a new high. So this becomes the structural level. If the market repeats the same thing, comes here, sweep liquidity at this point, and when goes back higher. Now you could see that in this case, the recent low, because of its sweeping of liquidity, is now the structural level. Now this is what you can check on the chart often for you to get good clarity on, right? So let's get to see how this is applicable on the chart. All right, let's I'm currently on odd USD, but I think we will need to make use of um G, GBP USD. I love GBP USD. I love gold and what have you. Let's see how these things work here. You don't forget we said that lower lows, lower highs, and all of that. And then when there would need to be a shift, we say that okay, fine, we would love to see a certain stuff. So for this very case, you could see what the market is doing. Now we have a high that produced this low, breaking down here to this point. Okay, it retraced, right? It retraced to this point, came down here, retraced to this point, came down here. Now, oh, just like we said, there was a sweep of liquidity at this point because this becomes a structural level. Liquidity was swept at this point, and then the market even went more down. All right, this is going to be continued in our next tutorial. I'm out of power. I just said I should do this. I know that it wasn't going to carry me for long, so I needed just the 15 minutes, but we have gone way beyond 15 minutes. Don't forget to hit the subscribe button so that our next video would come your way. And we have only discussed structural level and break off or market structure or shift of market structure in this very video. Hope to see you soon. Bye for now. Don't forget, hit the subscribe button. It is from Jedix TradeX Academy, one of your very best forex tutorial that helps you to build a better trading understanding of the chart. All right, see you in the next video. Thanks.